The primary use of nickel is in the creation of stainless steel. Guess what? The building that happens in an economic recovery needs copper and it needs stainless steel. It needs all of those things, right? So from a vantage point where nickel was probably underpriced.
Please join us for our next live stream Thursday, February 25th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be February 25th at 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to our channel or if you haven't already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up if you like what we do. We truly do appreciate your support. Today's guest, a first-time guest here on SBTV, is Gwen Preston, the resource maven. As a senior writer with the Northern Miner, Gwen spent years visiting projects, interviewing geologists, management teams, and analysts to understand which projects and pieces of news matter and why. In the midst of that, she spent 2 years working with Marin Katusa of KC Research, where she learned about capital markets. Having a deep base of knowledge and a network of contacts across the sector, Gwen is indeed the resource maven and knows mining and exploration. And we're delighted to have Gwen join us today. It's time to saddle up and silver up for the resource maven. Gwen, welcome to SBTV. How are you doing?
I'm doing very well. Thanks very much for having me.
Glad you could have you on. We thank you for the time. We're excited to speak to you. It's our first time having a chance to speak to the resource maven, so looking forward to it.
Thanks. Yes, I love the name Resource Maven. It seems to work well for my business. A maven is someone who understands through experience and likes to share knowledge. And so I've been in the metals and mining space, researching it, writing about it, and investing in it for 15 years. And I love sharing what I have learned through that experience and what I understand as opportunity in this space right now.
Hey, great. We appreciate you sharing your knowledge and insights with us. Gwen, in a recent video you put out, you mentioned 4 things that metals need to see for a strong foundation: strong demand, weak dollar, negative real interest rates, and a need for investors to diversify or seek yield. What led you to the conclusion that these 4 points are the main points, and can you touch on each of them?
Absolutely. Yeah, for sure. What led me to it is just that I do spend all of my time trying to understand where we are in the macroeconomic space and whether that is bullish or bearish for commodities. And I say commodities, I really mean metals. That is where my focus is. And so, and it's a very interesting question to grapple with on a regular basis, because of course, copper is influenced by different forces than gold. Gold is really the weird one in the mix. Gold and silver are the weird ones in the mix. And then the other metals are a little bit less weird, but nonetheless, they're all very macroeconomic, right? And so when I try to understand for myself a framework, and then when I try to explain a bit of a framework, that's what I come to there. So starting with strong demand. So I'll just say that with gold and silver, again, they're a little bit different. Silver's, I think we all in this audience would understand silver is the one that sits in the middle, being partly a investment demand and partly an industrial demand story. But certainly you need good demand. I mean, you need people to want to buy the thing if the price of the thing is going to go up. And so are we in that setup? Well, we certainly were for gold and silver last year. And in the last little while, we're recording this on the 19th of February. And in the last little while, silver has been surprisingly strong. I think fundamentally we are in a setup where demand for gold and silver is pretty good. And the reasons for that are varied, but sit primarily with the third point that we'll get to, which is negative real interest rates. As for the base metals, I think it's fairly clear that we're in a setup of pretty strong demand, and that's because we are hopefully heading into an economic recovery from this insane COVID bump. And, this COVID depression, I guess bump is the wrong word, depression. And there's oodles of stimulus directed specifically at global growth. And so should that spur demand for metals? It absolutely should. And I think it's fair to say that the green metal component of that is the safest bet, in particular because there are large parts of that stimulus plan that are specifically directed at green infrastructure and energy infrastructure. And green metal, energy metal, they're the same thing. So I think we are in a position of strong demand. Ideally against weak supply is the corollary to that statement. And we are definitely in a situation of weak supply for most of these. Now, weak can mean all kinds of things. We're not running out of copper tomorrow, but over the next 5 to 10 years, we don't have enough copper for this green energy revolution. We don't have enough nickel for this energy revolution. There's lots of metals wherein the supply scenario is insufficient because metals have not enjoyed the bull market that broad equities have for all of these years. And so there just hasn't been a lot of investment. So I think that first point, which is strong demand ideally against weak supply, that one is pretty safely met. It's going to be a bit of a long answer. The second point there was a weak dollar. So really what you want is not a strong dollar. I mean, that's the starting point, because a strong dollar is an absolute headwind for metals that are predominantly based in US dollars. So a strong dollar just hurts them as they try to ascend. Are we in a weak dollar scenario? I mean, right now we're in a bit of a flat dollar scenario. It's a bit range bound and it's not doing anything too dramatic outside of, COVID crashes themselves. But I think there's lots of systemic reasons to believe that the bull days of the US dollar are done and that we're heading into a bear market. I don't think it's going to be a dramatic bear market, but I think it's a shift from those strong days that we had previous. So I think that the easiest line there, the safest line there, is that a strong US dollar is not going to be a major headwind for metals as they rise. Will we get significant US dollar weakness? Well, that brings us to the question of inflation, which we could spend the whole hour talking about inflation if you want. I think people might fall asleep in their cereal, but there's certainly reason to believe that inflation is coming. It doesn't look like it's here right now, other than in financial asset prices. But there's so much money being printed and handed out, and we are in an economic recovery. There's a lot of reason to believe that inflation is around the corner. So that means weak dollar weakness. And then finally, we get to negative real rates. And so this is an interesting one right today, because negative real interest rates are absolutely the most important driver for gold. And silver often moves with gold. At least it moves with gold on its investment side. Its industrial side has different drivers, but on its investment side, it moves with gold. And if you look at charts, like the best correlation, almost the best correlation out there in metals is negative real interest rates and the price of gold. Negative real interest rates being inverted. So the more negative, the negative real interest rate, the better gold performs. And the classic reason for that is that dollar-based instruments therefore don't yield. And so people go to an instrument that does yield. And then beside that point, sitting right beside it, is the idea that it's a very good, strong idea that gold also performs in negative real rate environments, in the kinds of macroeconomic conditions that create a negative real rate setup. Those are the ones that also, for other reasons, drive gold. So not only are you avoiding a dollar instrument that's eating your yield, you're also buying something that is ascending. And we were headed towards a negative real rate environment before COVID hit. The real rates were already declining, and then COVID, bam, slammed interest rates to zero. Negative real rates fell for the first 6 months. They bumped a little bit, and then for a few months, and then now they've been sort of sliding again. So that setup is very much present for gold. Why is gold not shooting through the moon right now? Well, that brings us back to, guess what? Inflation. Because right now, gold seems to be responding primarily to nominal interest rates instead of real interest rates. So nominal interest rates are not corrected for inflation. They're just, what does the 10-year treasury yield, or whichever duration you want to look at. And the thing is, I think I wrote about this a lot in my newsletter just this week. And I think the reason there is because it's very tough to know when inflation is actually going to manifest. We don't, it should happen, but it's hard to know when. And so the easier thing to look at right now is just nominal yields, because they exist. They are. You don't have to make assumptions or calculations about inflation. And right now, nominal yields have been rising. And why is that? That's because people are selling bonds. Why are they selling bonds? Well, because the Biden administration is about to put $1.9 trillion more into that market, which already had a lot of supply. And so have we turned into a cyclical bear market for bonds in terms of price? I don't think so. I mean, that's a trend that's been getting established for a very long time. But I think we are in a pause in the bull market for bonds. And so nominal yields are rising. And because there's all these questions about when inflation will come or not come, I think that's just put a bit of a pause on people's interest in the idea of negative real rates. And so they are very much present. They absolutely work. Negative real rates are not going away. Can you imagine a central bank raising rates right now? That's like not happening. And so the negative real rate setup is here. We're just having a pause in focus on that because of the question of when inflation is going to show up. I actually don't remember. Did I touch on all four of them or did I skip one?
No, you did. Hey, I feel like wrapping it up. I'm ready to go out in the world now knowing all of this. Great info, Gwen. Appreciate it. We touched on the demand stresses for metals and miners right now. Do you think they have time to move from exploration to production in time to meet the demand for what some call the green energy era or even the electrification revolution?
I mean, it's a good question. And it's a question that the metals space grapples with on a regular basis because it is just this cyclical sector where you get these surges of demand and those prompt new project builds. And then with a very significant lag, because it takes a really long time to permit and build mines, you get a supply surge. And then usually that comes at some confluence of supply then going beyond demand and macroeconomic conditions changing such that demand isn't as strong as it was anyway. And so then you get that pushes you down the other side of the hill and you go back down into your bear market and people cut project spending, exploration budgets get slashed. And then guess what? You get in a demand insufficiency set up and you can just start over again. So this is a normal thing because metals are cyclical. How is it going to work right now? Well, we were in the bear market for metals from 2012 to 2015 was really bad. And that was exacerbated by the fact that mining companies had overspent in a ridiculous way in the bull market, which was driven by the ramp up of Chinese demand from call it 2004 through 2011, with a bit of a bump for the global financial crisis. But there was a crazy bull market there. And the unfortunate thing is that miners really got focused on production for production's sake instead of focused on making money, which is what they're supposed to do. And so they overspent ridiculously on projects because the whole market got so hyped. And so not only did they spend too much to buy projects, then they got committed to building projects that were just insane, and you'd see capex blowouts from 3 billion to 7 billion. And right, it didn't work. And so in the bear market from 2012 to 2015, we saw write-offs that would that make you shudder. They're terrible. Like billions and billions and billions of dollars got written off in these acquisitions and these overpriced capital commitments. And so then what have we been doing since 2015? What have we been doing for the last 6 years? Well, miners have been, thankfully, refocusing on making money. And so they got rid of ridiculous debt loads. They streamlined their portfolios. They made sure that their operations made sense. They canceled insane builds, and they made themselves make sense. And now, what's great is that now that metal prices are strong again, miners now stand out across equities for their balance sheets. They're in net cash positions. The vast majority of them do not have debt relative to their bank accounts. It's beautiful. And they're printing money. They are copper miners, gold miners. They're handing out money to shareholders. A lot of them are even buying back shares there. And that really stands out across equities. I mean, Newmont Mining boosted its dividend yield to 3.8% the other day versus an S&P 500 average dividend yield of 1.5. Like it's a different league. So, sorry, I'm getting to your question. What's great is that miners are in a really strong position right now. They could buy projects if they need. They can build projects if they need because they can get debt because they're not carrying any. They can do what they need to meet demand. First of all, the first question is, are they going to? And the second question is, are there projects for them to buy? And there are projects for them to buy, but the pipeline is not deep because the market has been so thin for so long. There hasn't been a huge amount of funding. And the thing about big miners is that they need big projects. They don't build small projects. They only build big projects because that's what they need to stay big. And the thing about big projects is that they are specifically hated when markets are weak. Because guess what? It costs a lot to keep a big project moving ahead through permitting and all of the drilling the boring infill drilling that it takes to get ready to do the engineering, blah, blah, blah. So they're specifically hated in bear markets, and a lot of them get ditched. They just can't raise the money to keep doing all of those things. So there are projects out there that can get built for sure. They are slowly getting bought. The M&A activity is rising and has been for sort of 2 years now. It's not dramatic yet. It's not exciting, but it's happening. And I think the optionality argument is in play, which is that those large projects that were so hated for so long, at some point miners go, okay, now we really have to buy something. And then sort of the optionality switch turns, and all of a sudden those projects go from hated to loved because there are so few of them out there, big projects that survived and kept moving forward in the bear market. And so if you can find big projects out there that are permitted or close to being permitted, that are ready to be built, that have good, social license to operate, those are going to get snapped up because the miners are sort of at that tipping point. They're like on the cusp of saying, okay, now we really need to get out there and buy, because they have the capacity to do so. And there aren't a huge number of projects out there that fit their needs.
Yeah, I was going to ask you about that, the M&A mergers and acquisitions. I mean, just a few years back, we saw quite a few of them, and this was when metals were pretty weak. Gold and silver were pretty weak at that time. This time around, as you mentioned, miners are doing very, very well. But let's say with all of these green new energy projects coming online, I mean, certainly there are going to be regulations that are going to be tied in with it as we move forward. Do you think some of these regulations are going to bring a new round of mergers and acquisitions in the mining space?
It's an interesting question. I think that there's sort of two sides to the political thing there. One side is just an increasing focus on, and this changes. This depends, of course, country to country, but in general, a rising focus on environmental protection and social license. And that is not just coming from, I mean, it's coming from the government side, but it's also coming from the miner side. They're increasingly understanding, in my view, not all of them. I mean, we still have Rio Tinto blowing up, heritage sites and getting in trouble for it, as they should. So I'm not saying that they're all doing the right thing, but increasingly, what I'm seeing in mining companies is doing ESG for the right reasons, which is that they should do it because that's the thing to do. So, I mean, I think that side of things, will it prompt M&A? I think what it is doing is boosting the position that M&A or that ESG, environmental and social governance, the spot that is on the list of importance in an M&A discussion, like it's gone way up, right? It's one of those actually go, no go things. Like I was chatting to a company yesterday that has a portfolio of like early stage pre-discovery projects in the Maricunga in South America. And they were chatting with a major who's interested in potentially partnering with them to explore those projects. And one of the key focuses of their early conversations was social license. Like, is it going to work? Can we explore there? Can we be friends with the locals? Can we work with them? And that's like pre-discovery for a major gold miner. So it's really boosted ESG on the list. And so when companies are looking to buy assets, if that is not in place, if there is not positivity built around ESG, then it's not going to happen. And so, that's one side of things. The other side of the politics angle here is that there is going to be specific support for certain commodities and the builds of projects that make those commodities more accessible. I mean, you can see that if you want to use uranium as an example. I mean, the United States just established a specific strategic uranium reserve because they rely on uranium for a fifth of their energy, and they basically don't mine any anymore, and that isn't a great setup for them. That's another long conversation, but they created a strategic uranium reserve to address that need. And I think they also have a critical metals thing going on where they're providing specific support for, things like really good graphite projects that are in US jurisdictions. And so they're actually going to help those projects move forward. They're going to help with money. They're going to help with some permitting efficiencies. So there's there's a bunch of political angles there. They basically start with, you better make sure that your project can happen on an ESG level. And secondly, it might get support if it's in a particular niche area that is really in need of supply.
Gwen, we are seeing the equities markets seemingly every week hitting all-time highs, and we're seeing the benchmark 10-year even rising. I think we're over 1.3% right now. And typically when both are rising in combination with the US dollar weakening, we're really going to start to see that inflation at some point. How do you see miners operating in an inflationary environment?
Yeah, good question. So in general, miners have their heydays in inflationary environments, and so there's two things to that. The first is that the inflation is making the inflation eroding the dollar, is making the price of their produced commodity higher, right? So copper prices increase in an inflationary environment just from the mechanics of it being priced in US dollars. So all the metal prices usually rise in that inflationary environment. And second, what's an inflationary environment coming from? Well, usually it's coming from significant growth. And guess what growth needs? Well, it needs copper and nickel and things like that. And so demand is also strong. So miners love inflationary environments. Now, when I spoke about how miners were overspending like crazy in the last bull market, a part of that, most of the fault sits with management who weren't concentrating on the right things. But a little part of it is because their costs also went up like you wouldn't believe, right? Labor costs went up. The price of a truck tire, the availability of truck tires for these big machines that work at mines, things like that. Like you couldn't get them. And when you could, they cost, your firstborn child. And so there is a cost factor that creeps in for sure. And so we're not there yet by any means. We're not even close. But at some point, should this bull market evolve the way that I think it will, you will start to see costs rise. So whether it's in the gold and silver space, you talk about all-in sustaining costs. In the copper space, that metric isn't so present. But nonetheless, it's the cost to produce the ounce or the pound of metal will start to rise. And that, is a challenge. But that usually only happens when the metal prices themselves are doing very well and the supply demand scenario is absolutely in miners' favor. So, there's always two sides to these coins, but it usually works out okay, or even well for mining companies.
Yeah, I had to ask that question because, miners, they're doing very, very well. And they were doing extremely well when oil was at about $30 a barrel and gold and silver were on the rise. And now we're seeing oil at $60 a barrel, doubled up. And gold and silver are going sideways. So, we're kind of wondering, is that higher oil price going to start to reflect or impact their operations?
Yeah, for sure. And I didn't specifically mention oil. I talked about labor and tires, but oil is absolutely a force there. I mean, the biggest one line cost at many mines is just powering them. I mean, you need to blast the rock, so that's explosives, but you need to dig the rock out of the ground. You need to truck it from wherever you're digging it over to the mill. Then you need to crush it and grind it. And guess what? It takes a lot of power to run crushers and grinders, all those mills. So for sure, I think for a long time now, I mean, miners have long been aware that that is their biggest, that's one of their big cost inputs. And so miners certainly look for jurisdictions or locations where they can tap into a national energy grid, that's ideally not powered by gas, so that is hydropowered or something like that, so that they have a little bit more certainty that power isn't going to become a huge flyaway cost for them. That's not always possible, but that's certainly something that's one of the considerations for sure. And yes, in general, that's part of that whole inflationary environment, is that fuel price, energy prices are usually rising as well. So that's the two sides of the coin there. Their demand is rising, the price of their metal is rising. That's all great. But, there's downsides to an inflationary environment as well, for sure.
I want to get back to the new administration in the U.S. We know with the electrification of everything going on and with the green energy movement going on, we're going to see more silver, more copper demand. And in this green movement and electrification of everything, electric vehicles are going to have a major role to play pretty much all across the globe. And a metal that looks to have a huge impact because electric vehicles use this in their batteries is nickel. And nickel is being used in higher quantities for electric vehicle batteries. I think we're at an 8-to-1 ratio now with NMC batteries. Do you think the upward price action for nickel is reflecting the growing demand by electric vehicle battery makers? Because just last March, we had seen nickel at about 11,000 per ton, and it's crossed 19,000 per ton now.
Yeah, for sure. So nickel's a great space. It's super interesting right now. It's obviously performing well right now. And there's lots of fundamental reasons for that. It's not a speculative move. It's a very real move. So of course, the primary use of nickel is in the creation of stainless steel. And so that remains the biggest driver of nickel. And so from that more boring yet very important side of the picture, what we're seeing is that looking ahead to an economic recovery. And guess what? The building that happens in an economic recovery needs copper, and it needs stainless steel. It needs all of those things, right? So we're looking ahead to that from a vantage point where nickel was probably underpriced. So there's that. Is the electrification side of things playing a role? Absolutely. I mean, you can take it. I'll use the sort of classic example. Most nickel juniors, so companies with nickel projects, probably mention Elon Musk in their presentations these days. And fair enough, because if Elon Musk glances sideways at a stock, it shoots up higher, right? But Elon Musk will also spend a fair bit of time discussing how the nickel pipeline of projects is not good enough. And he likes to say, if you can secure me, a clean supply, so politically clean, socially clean, environmentally clean supply of nickel, Tesla will take it. And yes, that's because batteries are using more and more nickel. And it's because of where nickel comes from. And again, this is a bit of a deep discussion, but there's two kinds of nickel deposits. There's laterite and there's sulfide deposits. A lot of nickel has traditionally come and still comes from laterite deposits, which are usually near surface. They're lower grade, and they're generally, because of the geologic process that creates them, they're in more tropical environments. They're not so much in colder places, and so there has been a range of environmental and political and social issues related to large nickel laterite deposits. And this is not a new story. This is something that has been ongoing for decades. Some of the nickel deposits out there, some of the biggest ones out there, are also just big, sort of messy situations in a lot of ways. And then, nickel ebbs and flows in pricing, and certain governments decide that they want bigger stakes in those nickel projects, and or they want the thing that is produced from a nickel mine, which is something that needs to be refined. They want that upgrading of the value chain to happen domestically. So they want refineries built domestically, which is just another hiccup in the nickel supply chain, because guess what? Refineries are super expensive to build. And so there's lots of complications on the nickel laterite front. Because of that, and because nickel sulfide deposits don't need to be smelted and refined to turn into the thing that you need for batteries. Basically, a nickel mine can pretty much directly produce that product. Nickel sulfide deposits are fantastic, but nickel has been a pretty darn boring commodity for like 15 years, and so there were hardly any. I mean, that's sort of the time frame that I've been in the mining space, and I can't say that nickel has ever grabbed the spotlight the way that lots of commodities take turns doing, at different phases in different markets. Like everyone's super excited about gold or copper or silver or cobalt or graphite or whatever. It's small to large, something grabs attention. Nickel never got that opportunity. It's just been darn boring. And that means that there hasn't been a lot of investment money put into it. And so there haven't been a lot of sulfide deposits found. There are some out there for sure, and that are moving ahead and that I think are pretty darn interesting because they will be in demand, kind of like that whole big miners need big projects logic that I ran through. Stainless steel manufacturers and battery manufacturers need the product that nickel sulfide mines create. They can also get it from those laterite mines. It just has to go through an extra and somewhat expensive step to turn it into the right product, but it also can come from there. But ideally, they would love to lock in supply from nickel sulfide mines. And so if you are interested in the nickel space, I would encourage you to look for people who are finding or developing nickel sulfide deposits in supportive jurisdictions. There's not that many out there, but I think those are the ones that are going to shine specifically in the next few years.
Oh, great point. Yeah, I mean, nickel had its heyday back in about 2008, 2009, around there. It was about 50,000 per ton, which kind of leads me to my next question. You mentioned two different types of nickel, and it kind of filters down to we have a class 1 nickel, which is for electric vehicle batteries, and a class 2 nickel, which is for more like construction type of work, stainless steel, things like that. With class 1 being the type of nickel for electric vehicle batteries specifically, I guess I could say specifically for electric vehicle batteries, do you see a time where perhaps a bifurcation or split between the two nickels actually takes place?
Yeah, that's definitely possible. I think the metals trading is a world unto itself. And so those of us who invest in and look at the metals and mining space, we're on the outside of that world. We are not on the inside of the metals trading world. It's a pretty complicated scenario. And so there's all kinds of middle people who bridge that gap between what comes out of a mine and what the end users need. And so they work with the smelters, they move metal around, they work with, the needs to blend concentrate from this and from this mine and this mine because of the different things that are in it to produce the thing that this particular smelter can work with. Metallurgists, go off about this stuff, and as they should. This is what they do. I mention that because the whole world of metals trading will manage that bifurcation, and that doesn't mean that it won't exist, but it might mean that the external investor in the metals space has a bit of trouble getting clear exposure to that, a class 1 versus class 2 nickel price. What will probably, and what is perhaps already in play, is that if you want exposure to that, you work on investing in projects that are likely to produce one kind of nickel versus the other kind of nickel, because like I said, the sulfide projects clearly produce the one. The laterite projects can produce one, but they first produce the other. So that's probably the easiest way for the investor to get exposure to one versus the other, because that bifurcated price might be a long time coming and might be difficult to see from the outside.
Well, when that bifurcation comes through, do you think it's going to be the class 1 that'll have a higher price, or the class 2 that'll
for
have
sure.
For sure.
I mean, in terms of, well, actually, it's a very interesting question, because, and it'll depend a little bit on how all of these things around, major laterite mines and the struggles that they have, how those evolve, versus, whether the surging interest in nickel really helps some of the newer sulfide projects advance and start to produce, get into production. The class 2, so the nickel that feeds into the stainless steel market, that's a way bigger market, like way bigger, like many, like orders of magnitude bigger. And so the smaller market needs, it's a higher grade, it's a more pure product, and it's of a particular chemical form. But the main thing is that it's a more pure product. That's what you need in the batteries. And so technically it absolutely should have a higher price. It's more rare, it's more pure, it's more specified. And so those things all mean that absolutely it should have a higher price. And it probably will, for sure. I mean, and it will for sure. The other side of the coin, though, will depend on how the whole laterite situation plays out. So it's not like that price is going to be weak, is what I mean. That price also has factors at play that are supporting it. So what the gap will look like, I don't know. And again, like I said, I don't know how much we will all see that. It's an unclear outlook right now, I would say.
Gwen Preston, the resource maven, before we wrap up, can you tell us or how our viewers can follow you and how they can learn more about your work?
Thank you so much for asking. I publish a series of newsletters that are about what I'm buying, selling, and thinking in the metals and mining space. So, and there's a series of letters because they are designed for different levels of investors. So if you are new to the metals and mining space, I have a letter for that level of knowledge and lower risk tolerance. And then I have letters that are, for those who know a little bit more about the space and are more interested in the speculative side of explorers looking to make the big share price move as they discover new deposits of gold or copper or nickel or whatever it might be. And all of those products are available at my website, which is resourcemaven.ca. And just on a business model statement, I don't take money from mining companies ever, or from companies ever. I'm a subscriber supported business. So my goal is to just help investors make the most of what I see as an exciting opportunity in the metals and mining space.
Gwen Preston, the resource maven, we appreciate the time you've given us, and I hope we can do this again soon.
Thank you so much.
That was Gwen Preston, the resource maven. To learn more about her work, please visit resourcemaven.ca. If you like this video, please hit the like button and subscribe to the SBTV channel, and you can also find SBTV on iTunes and Spotify.